Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the Mayor of Beckerville, USA, Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good. Getting ready for the Old Capital Conference coming up soon. It's just mere days away.
Yeah, a couple of days away. We're looking for you. If you are an apartment investor, general partner, or even a limited partner, we want you to come to the Old Capital Conference in Arlington, Texas. This is a premier event. It's a nationwide conference that brings people all across the nation into Texas to network and get to know people. We're not really educating people about how to buy apartments, but we're talking to the people that maybe are looking to buy apartments, because we have guys like our guests coming in here that you have a chance to meet and shake their hand, get to know them and visit with them and their team. So all kinds of different vendors. We'll have lenders there. We'll have attorneys there. We'll have everybody that helps you put together your transaction. So it's a great networking event. Only happens one time a year. OldCapitalConference.com, Old Capital Conference. We'll see you there September 14th and 15th in Arlington, Texas on the 15th. So, Michael, we're looking forward to having you talk on one of your sections. What are you going to talk about, Michael?
I'm moderating a panel with, I think, 4 of the listed brokers in town. So it's just going to kind of go over what they're seeing out there and kind of the state of the market. So we're going to do a little preview of that with another prominent listing broker here in Texas.
Yeah, unfortunately, this listing broker that we're going to have on, it cannot make the event. And so what we wanted to do is kind of get his feedback to share with you today about what he is seeing in the market. He's going to be on a trip, and so he's going to be out for the conference. He's attended the conference for the last 5-6 years or so, but unfortunately, he's going to be out. And so let's get to talk a little bit with Nick Fluellen with Marcus & Millichap in Dallas. Nick, how are you?
I'm good, Paul. Thanks for having me today. And Mike, always good to visit with you as well. And certainly bummed about the conference. My streak is broken. I've been to every one of them so far, but it honestly is probably the best conference that I go to every year. It's certainly the most well attended by investors who are actually doing deals. So my team will certainly be well represented, and I will be there in spirit, but I will not be able to make it this year, sadly.
So, Nick, tell me a little bit. You keep on getting more titles over at Marcus & Millichap from your outstanding performance. I mean, you are one of the top guys within the Marcus & Millichap system, and you just recently picked up another title. Can you tell me a little bit about that, and what was that like?
Yeah, I just was promoted to executive managing director, which is the highest title we have in our firm. And I guess really what that proves is if you work somewhere long enough, eventually, they'll give you any title they've got. But it's definitely an honor. There's only, we've got 2,200 agents around the country and in Canada. And I think there's only 20, maybe 25 that have that title. And a lot of those are institutional agents. And so, and not all multifamily guys either. So it's a great honor. I certainly am super humbled by the honor. But practically speaking, it's nice to have it. Doesn't change too much on our end, other than for a little while at least, gives me a little bit better of a title than Bard. So,
So, a lot of people know who Nick Fluellen is, and he was part of the Fluellen Hoover team over in the Dallas Fort Worth office, Marcus & Millichap. But I'm going to kick it over to Mike here for people that may not know Nick, and maybe Mike, you can ask your first question is, tell me a little bit about yourself, Nick.
Yeah, Nick. So we've known each other a long time. Then maybe we can go through the background. We've had you on 5, 6, 7 times on the podcast before, so people probably know who you are. But those that
I think I was guest number 2. I think I was literally the second one ever on here.
So, that was a long time ago.
It was a long time ago. I've been on a few times since then, but yeah. So I could share a little bit. So I've been with Marcus & Millichap since 2004. Mostly, I I would say historically doing B and C type assets. Generally, it's been 80s and older. I think over time, what's happened is we've grown and our clients have grown. Of course, a lot of people end up flocking to something a little bigger, a little newer. We've certainly done some a lot of secondary markets transactions, initially kind of on accident as they would come in on a one-off basis. And then after doing that for a number of years, we're like, well, we've actually built a pretty significant presence in the secondary markets. And so we brought on some guys to focus specifically on that. And so we've had a really, really strong run in secondary markets, really in this entire region. And then, my partner, Bart Hoover, joined me about 12 years ago, and everybody knows Bart, but Bart's just a great guy and a phenomenal broker. And so been lucky to get to work side by side with him for all of these last several years. So that's it. We've got about 21 people on our team as of right now.
I was just about to ask you. I mean, you have just a talented team of men and women that work not just for the company, but for you and Bard. And you cover some. Can you throw out a couple of geographic areas that you have coverage in?
Yeah, I mean, we're obviously East Texas, Tyler, Longview, et cetera, out there in some of the smaller towns as well. Central Texas, Waco, Temple, Killeen, College Station, Abilene, Midland, Odessa, and then we've done a ton of transactions in West Texas, Amarillo, Lubbock, on all the way out to New Mexico. Done a bunch of stuff in eastern New Mexico, some deals in Albuquerque, and then quite a few in Oklahoma as well. We've got a deal in Arkansas right now. We've done some in Louisiana as well. So really this entire region. Done some in South Texas, not as many, though I would say Corpus, we've done a handful of recent transactions down there. So we try to, it's a big state, it's a big region, but there's a lot of deals, but we try to cover it as best we can. We also happen to have two guys that just focus on 75 unit and under deals. And so the idea behind that really is if we can be a part of working with investors who are buying their first deal or two and helping them grow, it's rewarding for us to kind of take a client from that on all the way up to where we have some guys that, are buying 30, 40, $50 million deals that I started off selling 12, 16, 20 unit deals to, 15, 16, 17 years ago. So that's a lot of fun. But I guess the main message I would say is regardless of the size of an investor listening to this, we've got something or someone that will work with you, whether it's in DFW or just this entire region of the country.
So you got your executive managing director title and your A-list preferred title on Southwest as markets you cover, I guess. So do a little bit of everything.
I got a companion pass on Southwest. So,
well, good. Well, it's been an interesting year. I mean, it's been pretty high highs and kind of cooled off some. And now it's, in my perspective, it seems like the last 60, 90 days, water's kind of finding its level a little bit in the market, and sky's not actually falling. And we're kind of seeing deals still happening and trades happening, albeit maybe a little bit lower than the peak. So maybe kind of take a moment or two to kind of go through your perspective of the last, say, 12 months or so, and kind of what you've seen, and kind of what's your high level takes right now of kind of where you're seeing transactions get done.
Yeah, well, I think that summary is probably right on the money. We started off this year absolutely the best start we've ever had, and actually we started off last year the same way, and we started off the COVID year the same way. So we've had a big opening quarter in the last few years, and really this year longer than that. And then obviously when the Fed starts raising rates, a lot of these price points that we've achieved have been certainly a combination of exceptional fundamentals and population growth, job growth, et cetera. But it'd be naive to say that the debt didn't factor in significantly to those values as well. I mean, obviously your math works well if you can get a higher leverage, super low interest rate loan with multiple years of IO. You could make a lot of those deals work. So, once the debt fund market sort of dried up, all of a sudden we're to this point where all of these deals we were doing were 75% loan to cost type deals, and overnight that wasn't available anymore. And so there was a significant reset, I guess you could say, or just a stepping back, a reset if you were in escrow, and a stepping back if you were not in escrow, just, you didn't want to put a deal in escrow and go hard with significant amounts of money, only to see the Fed raise rates on you 150 basis points while you were in escrow. So it was an interesting time. I don't think, I guess COVID was similar in that respect, in that you had all this momentum and then almost overnight it kind of turned off. But for different reasons. Obviously, COVID was something we probably won't ever experience again. This is something that we do experience, the capital markets changing and inflation happening and all that. So I would agree with the assessment that it got very slow for a while. I mean, I would say activity was maybe down 80% or more just in terms of tour activity, CA activity, and all that. It was just, everybody was like, pencils down. I'm not going to go get into the wild unknown here.
And that time frame is what, like April, May, June, July?
Yeah, I'd say coming into the summer. And, I would say, generally speaking, the summer months are slower for us anyway, because a lot of people are traveling and enjoying, if they've got off to a good start and bought some deals. A lot of them are, especially private investors, are summer vacationing, doing family stuff, et cetera. So I think you had, it was a combination of seasonality and, on top of that, just extremely uncertain debt markets. I think what we've seen is, with some of the deals that we have in escrow, and I know you guys both specifically have done similar transactions, is that all of a sudden the 55, 60% agency loan with, call it mid to high fours interest rate with still quite a bit of IO, interest only, is something that was not in play at all for the last 3, 4, 5 years, and all of a sudden is kind of the go-to product. So that's been an adjustment. So I think there's still a lot of investors out there that are like, I don't know about that. I don't know if that's what I want to do. Do my numbers still work? Can I get the equity multiples and the IRRs that I'm seeking? And so those people are still sitting it out, waiting and trying to figure out what's going on. I think there's others that are like, okay, hey, there's the pricing discount, maybe 7, 10, 12%, in some cases, depending on the vintage, location, some other factors. And so I'm going to go buy this deal at a lower basis. And I fully expect that by the time I'm selling this deal, the capital markets will be more settled than they are now. Rates will probably go back down at some point during their holding period, and they'll be in the money because they continued to buy when other people were sitting on the sideline.
So we've seen, when I started my career, we bought a lot of stuff that you typically have sold historically. A lot of the C and B workforce housing stuff, and then to me it didn't make a lot of sense the last few years when the cap rates kind of all compressed on top of each other, where there really wasn't much variation between the top of the grade and the bottom of the grade. Mm-hmm. Are you starting to see that kind of expand or some separation between the various assets out there? Yeah,
100%. I know we've had that conversation many times as far as cap rates, and I've never been a huge cap rate guy anyway. I mean, I think I'm more of a global business plan type person, but the cap rate's relevant because that's a quick snapshot that'll tell you, hey, I can get this loan today. And obviously you can implement your business plan and go from there. But I 100% agree. The cap rates were kind of on top of each other, A, B, C. Then the upside story really came into play more in terms of assessing your multiples and IRRs and all that. I think now the C stuff is the hardest stuff to sell right now. I mean, there's definitely I really think the B stuff is kind of the sweet spot, in all honesty. I mean, I think there's still people that are seeking the new stuff. I just put a newer deal in escrow off market, and there's definitely people seeking that. But I do think that the cap rate delta is probably 7,500 basis point difference from 70s, really 60s and older type stuff. Flat roof, chiller type deals are just a little more challenging right now. Doesn't mean there's not a buyer for them, but if there is a buyer, they definitely want a better deal and have to have a better deal, in all honesty, because their rate's higher just to make the economics work. I don't think they're quite as on top of each other as they have been, and they're all certainly higher than they would have been 120 days ago.
So you're seeing a 7,500 bips spread in between like a B deal, an 80s deal versus like a 70s to 60s vintage. Is that roughly what you see now?
Yeah, I think that'd be fair to say. I mean, I still think the 80s type stuff is 4.25, maybe 4.5, and the C. Yeah, and then the C stuff is going to be, and I mean, look, the fundamentals haven't changed. Everybody's still crushing their operations, so I don't think that part is big deal. But and then the C stuff, I think people, if people want to sell it, need to sell it, it's just probably a little bit higher. It's probably a 5 cap or low 5 caps. Again, depends on the quality and the vintage and the location and what's been done to it. I mean, there's a lot of variables, and that's why I'm talking about cap rates is always a challenging conversation because every deal is so unique.
Sure.
But I would say from a macro standpoint, there is that delta now, and those C deals need to be at a higher cap rate if somebody really wants to.
What's the specific feedback that you're getting on the workforce housing, the older section of the workforce housing segment that's making those more difficult? Like, what's the stress, I guess, that's causing the higher cap rate?
I just think if you're going to, in general, something older is going to be a little more risky anyway. And so if you're getting higher interest rates, on your debt, then you're getting lower yields. And if you're getting lower yields, you need to take some of that risk out of the picture, especially if you're doing a floating rate product and all that. So I think that's really the main reason. But I also think if people are uncertain, as they have been for the last 4 months, about what's happening, I think there's a flight to quality. And so these older assets, not that they're not quality, but they're just, I think there's fewer people that are willing to take the chance. And candidly, the competition is less on maybe the 80 stuff than it would have been 120 days ago. And so I think it's also a chance for some people to maybe be competitive in an area that they didn't think they could be. So we're having more and more kind of 1031 buyers and stuff that probably wouldn't have been chosen when you have 15, 20 offers from people that the private one-off buyer was not winning a lot of those deals in general compared to like a local person maybe that owns 10 other similar deals. So I think now those buyers are more demand.
So mortgage is getting insane again a little bit, just pricing the risk in of the older, less
that's how I feel.
Deals.
Yeah, that's how I feel. I do feel like for the first time in a long time, I do feel like there's a little bit more of a delta between each asset class.
And as far as like you mentioned, you touched on the buyer pool. So how's that evolved? I mean, one of the biggest things that's really been transformational in your career, my career, both our careers kind of span the same time frame, has been the emergence and the real power of the kind of the syndicator class, with the investment club. And really that's being something kind of on the fringes when we started our careers to now being, probably the majority of the workforce housing investment sales space has probably dominated the last, decade nearly, or certainly the last 5-6 years with a lot of the syndicator groups and how they got more sophisticated in their ability to attract and large amounts of capital pulled together and pull these multiple $1 million transactions off. What's kind of your takeaway, or what's your read of that right now? Because I think you're mentioning a lot of those guys typically start older, smaller. That's kind of the business that you've built with having different segments of your platform to serve the smaller and the secondary and tertiary markets and kind of get some of those people that start out small and grow up. So I think you have a pretty unique or a lot of exposure to that profile or the demographic. So what's your kind of take of their sentiment? And how's that evolved?
Yeah, I mean, I don't know. I mean, I think the investment community is, I don't know. I think these smaller guys maybe view this as an opportunity to move up. We're still doing some of that stuff. I think these syndicators are still very active. I think there is clearly a concern about raising equity right now. I mean, bottom line is everybody's concerned about raising equity. LP money is harder to get right now. If you're a pure syndicator and you're trying to go buy a $40 million deal and you need to go raise $15 million bucks, it's not been easy in the last 4 or 5 months. It just I mean, we've had more deals fall apart because of equity, and really that goes for single check writing equity too. In some ways, the syndicators have an advantage because if they lose a few equity partners, they didn't lose all their equity, right? They still had to go replace it. It may be challenging, but if you lose a single check writer at the finish line, then you've got a real problem. I'm supposed to close in a week and my equity just walked. So, I mean, I think the debt is not as free flowing and easy as it was a while back, but it's still there and it's still pretty attractive in the grand scheme of things. But the equity is a lot more hesitant and tentative. Though again, some of the more experienced operators are still getting these deals done. But I do think legitimately that is why a lot of people are remaining on the sidelines. They are not confident enough in their ability to go out and put a transaction together. So what does that mean? Does that mean that the $20 million deal is going to be more in vogue than the $40 million deal that everybody wanted 6 months ago? Maybe that leads to some more activity on maybe some smaller transactions. We've had some success with, in the last, really the last even 2 or 3 weeks, we've probably put 4 or 5 deals under contract that are in that $30 million or less range, $20 to $30 million range. And so I think that feels more manageable for the private investor now than before. So it's moving so fast and so quickly. I mean, here we are in September of 2022 right now, right? I mean, I may have a different feel for this in October of 2022. So we're figuring it out. I think even as brokers, as we were talking about the investors figuring out, should I be on the sideline? Should I still buy these deals? Can I do a 55% LTV deal? We were figuring out the same thing. I mean, at the beginning of this year, I was underwriting a deal. I mean, I felt very confident of the value of that deal. And the middle of this year was like, oh man, I don't know. I mean, I don't know if when we said no to deals, because I was like, I just don't think this is going to be worth it. I just don't think this deal pencils. So we said no to some deals that we really liked, but we just thought, I don't think this is going to clear the market right now. And I don't want to be the one that lays the egg on it if this is the pricing the seller has to have. So it's a weird thing because if you've been doing this as long as I've been doing this and you guys have been doing it, you generally feel pretty good about your ability to assess a deal. But this year was like step back saying, okay, like if I put buyer glasses on here and look at it through those lenses and put seller glasses on, look through it through those lenses, and then put my own on and look through it through those lenses. I mean, it was very murky, and so I think that's where we're starting to find that middle ground a little bit more. But even if we find the middle ground, we still have to have equity. So,
but Mike, you buy institutional assets, but you syndicate similar to like some of the B&C syndicators do. So you accumulate equity through individuals that want to write $100,000 check or a $2 million check or how much ever they want to put into your deal. How are you finding it right now to raise capital?
Well, we're right in the middle of an active raise. So far, so good. We're pretty early on in it, but the initial response has been strong and people are flowing. I think I got enough on the sheet. I think we're going to get home on this deal.
Is it the asset that attracts the equity or is it the operator that attracts the equity?
I think it's a little bit of both. I mean, at the end of the day, people invest in the sponsor more than they do the deal, I think, and as far as like the weighting of the investment decision, my perspective at least. But I think that, the story we're selling is basically, there's been some dislocation in the capital markets that's caused some pricing adjustment. The deal that we're talking about went out at a higher price, got awarded to another group at a discount to that initial whisper price. They fell out, and then we're getting it at a discount to that price. So that's a good story. And I think that's a moment in time that maybe is fleeting because all those deals that went out in the late spring, early summer have all been kind of set or pulled. So now the deals are coming out and I'm sure Nick is readjusting his economics and expectations for the seller. So he's not likely to whiff as much as he maybe would have been in April or May because the market shifted, and that's now being priced in guidance that the brokers are giving to the marketplace on the newer transactions. So that felt like a pretty good one, Paul, and we hadn't raised in a while. And I think, maybe Nick said this and maybe I just interpreted that, it's the lack of confidence within the syndicator pool, which I guess I'm kind of in that world to go out and do these deals. And I think that the less experienced ones are a lot less confident than the ones that have done a lot of deals that have, successfully gone full cycle on these deals. So it's probably the people that have been in the business, Nick, that are looking at your 100 unit 70s deal that have been in the business for 12, 24 months that are probably a lot more nervous than the guy that's been around for, a decade or so, right?
Yeah. I mean, 100%. And even some of these seasoned investors that have done 3 or 4 deals, and didn't have any issue raising money. I think those are still maybe those are the more nervous profile type investors versus like somebody like you and some of your peers who own enough deals and have enough sources of equity to where you're like, okay, maybe this one doesn't work out, but that's okay because I have a plan B and a plan C and a plan D. I think if you're just purely a friends and family, or investment group syndicator, then, potentially you're more nervous maybe than somebody that's like, okay, well, I have this single check writer, I have this family office, I've got these friends and family, or I have this group, oh, I'm getting ready to sell a deal, and so I need to redeploy those funds. I think people that are constantly transacting, that have investors that are putting wins on the board, they're less nervous than, maybe the people that do one or two deals a year.
Yeah, let's get a perspective about Marcus and Millichap. What's interesting about Marcus and Millichap is that they have, a couple different seats at the table. They do hotels, they do retail, they do all kinds of different property types, but within the multifamily space, they have the A quality institutional groups, and then they have the B and C type. Sometimes they kind of go backwards and forwards between the two, maybe investors. My question really is, in the big picture for Marcus and Millichap, for you, is that, who's really at the market right now? Are you seeing the institutional buyers buy more or less than what they were, say, 45 days ago or 60 days ago? And what does that look like again? I think we've handled it, but the B and C, are we starting to see some momentum gain back up right now in the B and C space? So kind of the chicken or egg, what market do you think are people being attracted to right now?
Yeah, I mean, I don't do it. Most of my clients are not institutional type clients. I can say our IPA guys have had a fantastic year, but I think they would be the first to tell you it's definitely slowed down, and there's fewer folks that are buying their deals, and they have less inventory out right now than they typically would. And we would say the same things about ourselves. We've already had our best year ever. If I just took the rest of the year off and played golf, which doesn't sound terrible, but we still got plenty more to get accomplished this year. And I think as of today, each of these investor groups is still active, just to a lesser level than they were before. But I think that number is increasing every single day. I think there's only so long, if you're a full-time real estate investor, or you're a mid-sized company, or you're an institutional investor, that you can just sit on your hands and do nothing. I could feel it in the market right now. I could feel it with some of the more recent activity. Feels like every day there's just a few more people coming back into the market. And I will say this, in the last week, there's a number of people that are now scrambling to try to get a deal done before the end of the year. They want the bonus depreciation.
That's exactly it. I mean, I'm starting to see that, is that if we get something under contract in mid-September, we can close before the end of the year, so we can capture that bonus depreciation.
That's right. So that's a big, that's a big driver, especially in the private world, in the B&C world. I mean, that's a big deal. And a lot of these even LPs that are 100, 200K LPs, that they want that, and they need that to offset some of their gains elsewhere. So I am still very optimistic. The funny thing is, and I always love these conversations with you guys, because we can kind of go back from a more historical perspective, and not a 5-year history, but we can go back to, almost a 20-year history of all being in the multifamily space here in DFW. But I mean, when I look back at my underwriting in 2004, which is, it's kind of cringy to look at, to be honest. It's just evolved so much, and hopefully my knowledge has evolved a lot since then as well. But we were underwriting 6.5%, 7% interest rates with 25-year AMs and no interest only. And I think if you frame what you see in the market right now with that in mind, it's pretty, it's still pretty attractive. It's just, I remember the first deal that I ever saw somebody do with a sub 5% interest rate, and I thought, I cannot believe this guy got this interest rate. I mean, it was like in the high 4s, and I just thought, oh my goodness. I mean, wow, what an amazing, deal this is going to be for him. Now, granted, we were paying higher cap rates back then, or selling deals at higher cap rates, but all that to say is, like, even when people are freaking out about the financing a little bit, and the interest rates and the volatility, I know of people that are locking rates right now on agency deals that are in the mid 4s, high 4s, with some flexibility on the back end and a lot of interest only. And so, yeah, maybe they're bringing a little more equity to the table. Maybe that's diluting the returns, but I don't think we're in a bad place. We're just in a place that people need to adjust their expectations. And look, LPs have been really spoiled for the last decade, really, where they're like, hey, this was a 3X. This was a 2.5X. And those deals are amazing. But there's nothing wrong with a 1.7 or 1.8 either. I mean, that's better than sitting on the sidelines. And a 1.7 projected with the chance for it to be higher, which they generally are, is something that I think most people should be excited about and will be moving forward here now that, it feels like the dust has settled a little bit. So again, to answer the original question, I think more and more people are getting back in the market every day. I mean, even compared to 30 days ago, I feel much more optimistic with where we're going to, for the rest of the year and going into Q4 here pretty soon.
Yeah, we had that similar conversation like this summer because we were beating our head against the wall and hadn't really bought any deals all year. We sold a bunch, and eventually I was talking to my partner, Sean. I said, either we need to stop working and just go like on vacation, or we need to buy something, because this working and not buying something is no good, because it's kind of the worst of both worlds. You're not actually producing anything and you're spending a lot of effort. So I wish I would have took the spring to go golf, like you said, or go to Europe or something. But we were trying to do deals and it didn't make sense. So I think that sentiment is certainly starting to get more and more popular. And I think we're seeing that. And I think there's very little inventory. So honestly, I'm kind of like debating myself, like, okay, do we get one more deal out? Because it seems like it might be a weird time. Maybe you launch a deal in October, November, which is historically a terrible time to do it. But you'll probably be the only, one of the few deals out at that moment in time. So maybe capture all the attention.
That's right. Well, and we've intentionally not launched a lot of deals over the last couple months, just because if the seller didn't need to sell, we're like, let's let the dust settle and let's see kind of how things, are panning out. And then let's launch when we have a better handle on, kind of who's out there and what's the new go-to debt, after these debt funds have pretty much gone from, option A, option B, option C to not being really even hardly on the table anymore. And so I think you're going to see more on the market in general. And you're right. Historically, people are always like, oh, don't launch a deal in Q4 or especially November, December. But I don't know, man. We've always had really good luck with those. I mean, we thought that way for a long time. But I think even on a normal year with normal circumstances, you do have everybody's attention when you have a deal out then. And that may even be more the case this year with lack of inventory on the market right now. So yeah, it's an interesting thing to kind of think through. And, everybody, obviously the risk in the market right now, and I know Paul is seeing this and having these conversations on his side, but people that have caps that are about to expire or bridge loans that need to be extended, that's the risk. Those are the people that really that are at a crossroads and need to decide, hey, what's the direction I want to go. But I think for people that have the debt that we were all kicking ourselves for having, the 10 or 12 year Fannie loans with huge prepayment penalties, I think those people right now are sitting back saying, I'll just wait. I'm operating great. My income's going up and I don't need to sell right this second. And there's no stress in their world. So yeah, that's what we're kind of seeing and checking out right now and evaluating on every deal that we're doing a BOV on and just making sure that it makes sense with what the seller's real goals are. And then we're going from there. So I think we'll see people that are coming up to the end of the original term or need to renew those caps. And I think that'll spur on some additional inventory and motivation in the market.
Let's wrap this up a little bit, because you may be fooled a little bit if you go onto the Fluellen Hoover website, that it may look like they have 10 or 15 listings, but they're doing a ton of stuff that's off market. So that's really what you need to build a relationship with Nick and his team right now to get some exposure to deals that are off market. Mike, is there any way that you could maybe have your partner Sean give you access for a title of executive managing director like Nick got?
I don't know. I do have my A-list preferred because I go to San Antonio and Austin all the time, but maybe not EMD like Nick. But
it does sound really good though. I'm not gonna lie about it. It sounds great. It sounds like I'm more important than I am, but
If people want to reach out to you or one of your teammates, what's the best way for them to get a hold of you?
The simplest way that's easy to remember is just our website, multifamilyadvisors.com. You're certainly always welcome to email me at nick.fluellen@marcusmillichap.com as well. Or you can just look up the Marcus and Millichap Dallas office and call and ask for me, and that'll get right to me. So, but really and truly, I love what I do every day. I love helping investors of all shapes and sizes and all geographies. And so I always look forward to visiting with new folks. And that's something that we've done a ton of over the years, is some of those folks that don't get the time of day from other brokers maybe in the market, or people when they're busy. I mean, we have built our team to be able to service that type of investor. And it's a joy and privilege for us to do that. So love to hear from anyone that's thinking about dipping their toe in, or someone who's saying, hey, I'd love to take the next step in my business and maybe sell something smaller I have and try to get into something larger. But regardless, we're here to help. And we also have an amazing research department. And so obviously happy to share a lot of that information as well.
Yeah, unbelievable research from their team over at Marcus Millichap. We know some of those guys, and they're the best of the best, and some great research that you want to have in your back pocket. So when you're having a conversation with your brother-in-law, your cousin that may want to invest into your deal, you can break out that information and share it with them. Michael, any final words before we say goodbye to Nick?
No, I always appreciate Nick coming on. And, if anyone's still listening to this, certainly go to oldcapitalconference.com. There's a couple days away, probably as you're listening to this, if you're watching it or listening when it first comes out. So it's going to be a good event to go and get networked with, and I'll be there both Wednesday night and on Thursday. So I'll let you buy me a beer if you're around. So certainly talk to you then. Yeah. But yeah, no, appreciate Nick as always. The insight is it's always good to have you on, because it's only thing that's certain in this business has changed, and everything's always changing and evolving. And like you said, what's true in September, you might not be true in October. So it's always good to stay constant communication with guys like Nick and stay on top of the active changes within the marketplace.
Yeah, Nick is a great resource. You want to spend some time, develop a relationship with Nick, and some of the guys on his team definitely are players in the Texas market. So we've had on Executive Managing Director Nick Fluellen. Thanks for spending some time with us. And
thank you guys.
And hopefully Michael Becker will get that title one of these days.
I hope so. Hey, thanks guys. Always fun to visit, and have a great conference. And let's bring some more deals home this year.
There you go. All right, Nick, thanks for your time. Appreciate it. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.